Right. Good morning to our wonderful audience, and thank you for joining the third day of our Offshore Investment Managers webinar. Really great to have so many of you back on the line, and thank you for your continued support. We always remain grateful. On screen now is the agenda for the day. If Dan can pop that up. We will cover a lot of ground on global macro, value, quality, global property, and emerging markets. All the presentations and recordings of all 3 days, including today, will be shared on the Boutique Managers website. If you're not sure where to find that, just give one of our team a call and we can direct you to the right site. As always, you're welcome to post questions in the Q&A bubble. So we're going to have each presenter do their session, and we'll take questions after each presenter, time allowing, and we'll see how far we get with that. With the Fed communicating the beginning of a rate cutting cycle, most argue that this will be a tailwind for growth assets in several geographical regions. However, if you listen to the likes of the BCA, the bank credit analyst in Canada, they're still very gloomy and they're still warning of a recession before the end of 2024 with growth faltering. We've seen some managers advocating for a turn towards more cyclical assets, away from developed markets or away from a frothy US market. But quality as an investment style could be more defensive if we were to see a recession. Who knows? But I think it's rather a case of not having to pick sides, but rather to find a way of balancing risks in clients' portfolios. This morning, a lot of our managers will speak to some of these topics and continue to unpack their views, but more specifically, how they identify opportunities regardless of the cycle we find ourselves in at the moment, and regardless of all the different views out there. Our first presenter of the day on the Global Equity Outlook, and all the way from London, you've seen him before, met him before online, Richard Cardo from Investec. Good morning, Richard. How are you?
Good morning, Eugene, and thank you for getting me out of bed so early today.
Richard, not that early, but yeah, I believe London not always great with weather. Thank you so much for your time. Really great to have you on board again. For our audience, this is a point of reference. Richard will specifically speak to the Investec BCI Global Leaders Equity Fund and their views on global equity. Richard, again, thank you so much for your time this morning. It's really great to have you with us, and looking forward to your presentation.
Thank you, Eugene, and good morning to everyone. Great to be with you and being able to present to you today. So if we just move on to the next slide, a little bit about, or a reminder about who we are and what we're trying to achieve. Thereafter, I'll chat to you very briefly on our view on current market dynamics, and then probably more importantly, how we position some of the stocks are in, where we're seeing opportunity. So just as a reminder, this is a large cap, developed market listed biased fund. Our investment style is very much quality growth. So we're looking for companies with sustainable competitive advantages or investment moats, providing goods and services into growing in markets. And the kind of quality metrics that we like to hone in on are typically return on invested capital, good free cash flow generation, and high and improving margins. We also tap into secular long-term growth themes. I'm going to show you a couple of stocks in that respect later on, whether it's in the AI world, playing towards the smart grid and electrification, or latest developments and opportunities in med tech. As a reminder, it's a high conviction concentrated fund. We typically own 30 to 50 stocks. We take decent active size bets. And to paraphrase, Charlie Munger, we believe that the big money is not in the buying and selling. It's more in the waiting. So if you look at our turnover ratio, it tends to be a lot lower than most of our peers. we invest with patience. So close to a 4-year track record, and we've got about 1.5 billion rand in the fund in terms of AUM. The strategy itself has been going for north of 10 years, and we've got close to $1.3 billion in assets under management. Just moving on to the next page. We like to think we actually do what we say on the tin. So these are some of the key fund characteristics. If you look at our return on equity for the fund, it's north of 27%. To give you an idea, the MSCI World is in the mid-teens. Return on invested capital is 22.5%. Again, the market is in the mid-teens. And the operating margin on a look-through basis for the stocks we own is close to 33%. Whereas for the MSCI World, it's close to 18. So, very much those core quality metrics that we're looking to identify are pulling through on an aggregate level in terms of the stocks we own. A pretty high active share ratio, which you would expect, given that we're not looking to own the market. We're looking to own a very small subset in the market. So the active share ratio is at 75%, and we currently own 40 stocks. Moving on to the next slide. Obviously, the market over the last 20-odd months, ever since ChatGPT, OpenAI, AI came to the fore in November 2002, has been dominated by, the so-called generative AI effect, the Magnificent Seven. And if you look at this chart here, you can kind of see the dark line, which is the S&P 500, which is, done very well. But then you can kind of see the dotted gray line, which is the S&P equal weighted index, which is up by far less. That's up 15% odd in the last 20 months versus the overall market up 40%. And that's due to that Magnificent Seven cohort giving you returns of north of 100% over that time period. Quite remarkable that the likes of NVIDIA have seen their revenue up by 4.5 times over the last 20 months, and the share price up by close to 600%. Moving on to the next slide. Why the fuss over the Magnificent Seven? So it's quite a busy slide, but on the far left, we're really just looking at the free cash flow margins, the dark line, which is the top line for the Magnificent Seven, which are tracking very hard, about 21%. And the dotted line is kind of the overall market. And you can see Magnificent Seven enjoy free cash flow margins of at least 9 percentage points ahead of the overall market. And similarly, if you look at the middle chart, that's return on invested capital, notwithstanding some worries that these guys are spending big on capex, playing to the AI tune, still generating very strong and in fact improving return on invested capital. That number close to 25% for the dark line, the Mag 7, whereas the overall market is coming in at sort of 15%. And then putting all of that together on the far right, you can see, in terms of the Magnificent Seven, that's kind of the gray and then the black as well. The black is excluding Apple, where the white bar charts are the overall market. You can see that the Magnificent Seven are generating, more than double the level of sales and earnings relative to the rest of the market, more than 2.5 times, the level of free cash flow relative to the rest of the market. So absolutely, there is some fuss over the Magnificent Seven because they are better businesses. But if we move on to the next page, how much of that is priced in? And what we see here on the far left is this cohort has grown to now comprise 30% of the overall market. If we go back, this chart goes back to 2012, but the last time it got to this level was kind of in the dot-com crash of 2000. So, caveat emptor. What I will say, and if you look at valuations, is that the cohort are also trading at about an 80% premium on the far right to the rest of the market, excluding the Magnificent Seven. Now, that might seem extreme. The kind of average premium that they've traded at is about 50%. But again, what I will say is if you look at that dark black line on the far right, it's been close to 200%, if not more, in the last few years. And if you look at, tech leaders of yesteryear, again, going back to kind of the new economy era when tech was leading, that premium has often been anywhere between 240 and 600%. So, yes, optically, they look expensive. They are better businesses. They deserve to trade at a premium, but perhaps they're not all that expensive relative to where they've traded in the past. Okay, if we move on to the next page, just a couple of slides on our top-down view On the far left, you can see composite purchasing manager indices at a country and regional basis. I think the key point here is that we do see the overall global economy continuing to grow, although there has been some slowing and more recent economic activity, but we're not forecasting a hard landing or a recession. In fact, if you look at the odds of a recession, they're currently at about 25%. A year ago, that was closer to 70%. And in a normal year, it's about 15%. And, just looking at Q2 earnings season in the States, the number of companies that brought up the word recession was way down on where it was kind of a year ago at about 10%. So yes, the economy is slowing, but we very much believe that it's probably correct at the moment in pricing and a soft or no landing. And then the big question on the next page is, to what extent interest rates get cut. As Eugene alluded to, last week's Jackson Hole meeting, Jerome Powell, the rhetoric coming out was far more dovish. There's a proper pivot by the Fed. We will get a September rate cut. The focus is now very much on the labor market, where there has been some recent revisions down, and that seems to have spooked the Fed. And perhaps there's a worry that they are behind the curve. The market is currently pricing in 1% in rate cuts by the end of this year and another 1.25% in rate cuts for 2025. And we would just caution that maybe the market's getting a little bit too ahead of itself. If the economy does generally hold up as we expect it to, the labor market in totality is still fairly robust. And the last mile in inflation, although inflation is falling, the last mile tends to see some sticky numbers in inflation. So we are not so sure that the Fed is going to be able to cut by as much as the market is expecting, but certainly the level of direction will be towards rate cuts going forward, which should be good for the market. Moving on to the next page. What's interesting is that if you look at the local, or rather recent sector market performance on the left, you can see it's the more defensive sectors that have been holding up best. And that's perhaps the market saying, well, the Fed's got to cut. That's obviously because, the economies are slowing. Perhaps there's a growth scare. So you've seen sectors like healthcare, staples, and utilities lead the way. Technology also performing well. And then at a regional level, the US leading all other markets. It tends to be more defensive. And on the right-hand side, you can kind of again see, cyclical sectors in the market, those more economically exposed, have been underperforming more defensive sectors of late. Moving on to the next slide. There's no doubt that valuations are fairly full. So the MSCI World is trading on a 17.5 times forward multiple. You recall that towards the end of 2002, that multiple was close to 14.5 times. So the market has re-rated. And that's within the context of, rate hikes. So, a bit anomalous that the market has re-rated, notwithstanding that discount rates have been going up. The US in particular on the right, and we showed at a regional level valuations, looks optically expensive. The market in America is trading on a 21 times forward PE. It started this year at 19.5 times. So it's re-rated. And the long-term average rating for the US market's probably closer to 16.5 times. There is, one kind of caveat to that, is that obviously, as I alluded to earlier, that overall valuation for the US has been distorted by the 31 times forward multiple of the MAG 7. If you strip that out, the rest of the market in America is trading on a much more palatable 17.5 times. I think it is fair to say that we do see more value elsewhere around the rest of the world, and in particular in Europe, where the market is trading on a forward multiple of about 14 times. The median stock in Europe is probably trading on anywhere between a 20 and 25% discount to the US market. We can flip to the next slide. We'll skip that if we can move on to the next one. Just in terms of earnings, I mean, what's quite interesting here on the far left, the dark blue bar graphs, that's the Magnificent Seven, and the rest of the market, the S&P 493, are the light gray. Now, what you saw in Q2 earnings season was the MAG 7 growing earnings year on year at 35%. You saw positive growth for the S&P 493. They delivered earnings growth year on year of 3%, which is a lot better than the previous quarter, whereby they declined by 9% year on year. So you've had some you've had a market that's really just been driven by the Magnificent Seven in terms of corporate profit growth, but that is starting to turn, and we expect more convergence and broadening out in terms of the areas of the market that are delivering earnings as the year progresses. And you can see that on the next page. In fact, the market is expecting MSCI World earnings growth of about 10% for calendar year this year in dollars year on year, expanding to about 13% next year. And in America, the S&P 500 in the top row, in aggregate earnings growth expectation in the high single digits this year, expanding to about 15% year on year next year. And that's really being driven by, still fairly robust sales growth in the mid-single digits, profit margins, which are holding up quite well, and, obviously our central view of the economy not collapsing, continuing to grow. If we move on to the next page, this just shows you quite interestingly the last 6 rate cutting periods in the US, dating back to the mid-90s. And what it's telling you is that defensive sectors, in particular healthcare, consumer staples, tend to be the outperformers when the Fed cuts. So in the first few months following rate cuts, those defensive sectors perform well, as do technology and communication services, where a lot of those kind of tech bellwethers obviously reside. It's really the cyclical parts of the market that lag when the Fed first starts cutting rates. You would expect, the effect of rate cuts to take some time, and then perhaps once they feed into the real economy, some of those cyclical sectors to catch up. But certainly in the beginning, areas like energy and industrials in particular, basic materials, tend to lag when the Fed starts cutting rates. Moving on to the next slide. Healthcare is definitely one of our preferred defensive plays. This just shows you, performance of healthcare. The gray shaded periods are kind of past economic slowdowns or recessions, and healthcare tends to perform best in those environments, which, we think we are going to see an economic slowing, not a recession. What I will say is that, healthcare does look relatively cheap compared to other defensive sectors, we believe, like consumer staples. Earnings per share revisions are on the up, and, there very much are some secular growth tailwinds, whether it's, weight loss, obesity drugs. We play to that via our holdings in Eli Lilly and Novo Nordisk, whether it's medical technology developments, which we play to through stocks like Intuitive Surgical, which is minimally invasive robotic surgery. We definitely think that healthcare is primed to do well going forward, and we've probably got about 17% of the fund value in healthcare, which is about a 40% overweight relative to its sector weight. Moving on to the next page. Just very briefly, I've identified a couple of stocks that we think are playing into what we see as current secular long-term growth themes. And Microsoft is one of them, very much at the forefront of the move to the cloud and AI. They're aiming to be number one in both of those areas. What's interesting is Azure Cloud now makes up close to 40% of group profit. It generates $80 billion of revenue per annum. They have a 21% market share, just behind Amazon Web Services. A great business whereby they generated gross profit margins, of close to 65%. We think that business alone can grow over the next few years, excuse me, to generate revenue almost as much as what Microsoft as a company generates today. So, north of $220 billion. More than 1 billion global users, 70% of all companies worldwide use Azure Cloud. And similarly with AI, one of the few companies, lots of talk about AI, but that are actually monetizing AI. So currently there's about a $5 billion annual revenue run rate, through their forays of Azure AI and Copilot. So very much, tapping into the cloud and AI theme. Another theme that we've identified, I'm going to skip the next slide, and skip the next one too. That's LVMH. Let's skip that. And the next slide skip is Schneider Electric. So they're all about the smart grid and electrification, powering AI. About 3/4 of their revenue comes from energy management, and a quarter comes from industrial automation. So a great play on the build out of data centers, um, building automation, the smart grid, and electrification of fossil fuel processes. This is a company where we think their return on invested capital can double over the next 5 years. And you're not overpaying. You're paying sort of a 24 times multiple for an industrial company that consistently generates operating margins north of 20%. Eugene, how long have we got left?
We at the 20-minute mark,
Okay,
Richard.
just perhaps 30 more seconds. If we can skip a few slides.
Fine.
Keep going, keep going, keep going. So last slide, just in terms of how we positioned, our top 10 holdings are on the left. So, Microsoft I spoke about Schneider Electric, Louis Vuitton, Moët Hennessy, Premier Luxury Goods play is also in the slide pack, as is Intuitive Surgical. Those stocks make up the top 10, 41% of the fund value. So very much high conviction concentrated. We overweight healthcare and consumer, and we've got a big absolute weighting in tech companies. Probably make up close to a third of the fund value. And then just in terms of our active position sizes, so that's what we own relative to what they comprise of the benchmark, that's in the table on the far right, you can see very healthy active bets too. So that talks to our level of conviction. Typically our active bets range anywhere between 4% and north of 1.5%. And much the same top 10 stocks in terms of active bets as are on the left-hand side, absolute weightings. You are seeing a few other new stocks though come in the form of London Stock Exchange, Palo Alto Networks, which is cybersecurity, and Danaher, which is life sciences and diagnostics. So that's really the story. We think we're well positioned to generate good returns going forward.
Richard, thank you so much for that. Articulating a lot of the information, especially around the global macro. Two very quick questions for you. We very much out of time, but I do want to deal with this. We get it a lot from investors in the audience as well. We're all talking about rate cuts. You spoke about rate cuts, market pricing in roughly about 1% cuts. But here's the big thing. I mean, if the economy is doing so significantly well, why cut? I mean, if nothing is broken, why would you cut rates? So what are the Fed seeing that we're not seeing?
I think that's the crucial question, obviously, and perhaps the Fed has seen something that it doesn't like. I mean, if you hear the rhetoric coming out of Jackson Hole, it's certainly not what we've heard up until then. As I mentioned, more recently, you've seen some downward revisions in those labor numbers, so weaker than expected, and maybe the Fed is seeing something in the labor market in particular that it doesn't like. In terms of, core economy, yes, delinquency ratios with regard to credit card debt, auto loans, etc., those have been ticking up. There is some pressure at the lower end consumer, but by and large, Joe Public US, we think, is in a fairly decent position. So, that inflation number is going to get to 2%, the number the Fed targets. We think only by the end of next year. So they're still some way off, which is another reason we don't think the cuts will be perhaps as significant as the market expects. But it is heading towards the target.
Just very quickly on Investec, I mean, you've got extensive global team. And I think, very often when intermediaries start digging into your business, looking at Investec, I think they're always surprised to see how big your team is, how long the business has been going, and what you have to offer locally and globally. But let's talk about the Global Leaders Fund. A lot of high concentration quality funds out there. In 30 seconds, why Investec?
Sure. So I think you benefit from obviously the scale, as you alluded to. We've got north of 220 billion rands worth in discretionary assets, and that's fairly well split both locally and globally. So we have experts on the ground, here in the UK, globally, and in SA. But we like to think that notwithstanding our scale, we remain nimble and entrepreneurial, the kind of key tenets on which Investec was formed. And I still think those key tenants, and everyone thinks as a shareholder and investor. In fact, most of us are shareholders. That's how we tend to be rewarded. And I think if you have that owner mindset, you tend to remain an entrepreneur and nimble and flexible in everything you do. So I think those are some of the things that stand out from a money management perspective.
Richard, thank you so much for that. And thank you for dialing in this morning, again from London. We're grateful for your time. There's an open question from one of our audience members, Sean. But we can take that, Sean. We're going to take that offline. We're going to get some feedback on that. Richard, thank you so much. Looking forward to speaking to you again in the very near future.
Thank you, Eugene.
Right, online already, ready to go for the past 5 minutes. Gary, sorry to keep you holding. All the way from Jersey, founder and portfolio manager at Martello Asset Management, Gary Hill. Good morning, Gary. Thank you so much for taking the time and joining us this morning. Looking forward to your presentation. Maybe just as a matter of interest for the audience, you've seen a couple of times Martello presenting. They are pragmatic thinkers, and they pride themselves of doing all their own research on companies that they invest in, and identifying securities that can give clients good active returns. Gary, thank you so much. Cool.
No, thank you,
prevailing.
Eugene. Good morning. Good morning, and good morning to all the participants on today's call. I'll start off quite quickly through some slides on the current macro environment, how things have developed since we last spoke in May, and then we'll move on to the portfolio, and I'll give you a run through as how we're positioned at the moment and any changes we've made recently. As you can see from the title bar, it's very much at the moment, August has been a particularly challenging month for certain investors, depending on how they're sort of positioned relative to factors involving the Japanese yen, etc. But clearly, from a peak of the market in July 16th, through to the sort of drawdown that we saw in global equities beginning sort of early August, it was quite a significant downturn of about 10%, peak to trough, led by certain factors, which I think everyone's aware of now, in terms of the weak job data that came out of the US, coupled with the Bank of Japan turning hawkish on their rates outlook as well, Japanese yen strengthening, very large carry trade unwind, leading to some very, very severe moves in terms of volatility, the second largest ever daily increase in VIX, followed by the largest ever daily decline the following day. Putting all of that into perspective, you can see that the reaction was extreme considering the data around it. We're talking about a slightly weak payroll data as opposed to other events which have caused similar types of volatility in the past. There has been a rebound since. Global equities now are a couple of percent above their previous peak. I'm glad to say that our strategy drew down by about 7% during that period and is up about 3% relative to its peak in July. So we managed it pretty well by basically doing nothing really in our portfolio and sitting with the stocks that we have and not reacting to what was going on around us. What else has moved? Well, 10-year bond yields have come down. They've reasserted their trend really since the October last year, with a few sort of periods where they've backtracked. They've moved down to 3.8%, which is where sort of significant support exists at the moment. High yield spreads ballooned by 120 bips and then came back all the way. They've rallied back strongly. Gold has continued to climb, hit an all-time high very recently, and gold mining shares have continued to outperform the gold share price over the last 3 or 4 months, really backed up by some amazing year-on-year earnings revisions that we've seen across the sector. So some quite significant moves that have happened. I think that the bond market move is very supportive, but I would reiterate perhaps what Richard was saying earlier, that some of this feels like front running a very aggressive sort of series of rate cuts from the Fed, which may not materialize in the same sort of time horizon that the market's expecting. Currency-wise, the dollar has fallen by almost 5% since the beginning of July, which is quite significant. The euro is at almost a 2-year high relative to the dollar. Swiss franc has rallied strongly as well as a safe haven currency, and the yen is obviously rallying now given the switch in monetary policy in Japan. It's not just been about sort of technical factors though. If you look at the euro current account balance, that's been improving considerably this year, and that's often correlated with a stronger euro as well. So what we judge from that is that the picture in Europe is improving. It's a healthier picture in terms of flows into the EU area, although the economic picture there isn't quite as promising as I think people would have expected by this part of the year. So are the moves justified? Well, if you look at the current 2-year minus Fed funds spread, we're actually at a level which is reminiscent of previous extremes around crises such as the banking crisis of 2008, market crashes and other economic recessions, which doesn't really seem valid given the economic picture that we're seeing. If you look at the growth gauges in the US, they've moderated from their peak of 2022, but they remain solid. In terms of GDP growth, the employment data is softening, but it's not falling off a cliff. And other financial gauges such as bank and credit spreads are not stressed either. In fact, very recent data on retail sales in the US and consumer expectations have been an improvement on data before that. So what we're suggesting is here that by betting on weaker growth, the bond market is actually helping to reinforce and prolong the current economic cycle, which is positive for the equity market, it's positive for earnings. Inflation hasn't been put to bed completely yet, but I know the Fed obviously has a dual mandate in terms of inflation and employment, and I guess these rate cuts are really sort of directed towards the employment side of things at the moment. In Europe, as I mentioned, that the picture isn't quite as positive, although from a corporate profits point of view and hiring data, that's actually much more upbeat. And clearly that's what we're focusing on in terms of our equity selection and our research. It's the corporate profit side of things that we're most attracted to. Central banks have started easing in Europe ahead of the US, and there's obviously more rate cuts to come. But again, we're not expecting perhaps quite as many as the market is anticipating at present. I think what's been lost in all of this actually is just the very, very, very strong earnings reporting season we had for Q2. It's completed now. 80% of companies beat on earnings and 60% beat on revenues over that period. It was a significant sort of improvement and also above expectation, I think, in terms of the number of companies and the degree to which they outperformed the expectations of them. Some very recent data from MRB Partners yesterday just shows how well earnings growth has developed during the quarter, and also how the consensus is developing for 25 and 26, nudging higher for 25 and rising again for 26. And normally by this stage of the year, you would expect to start seeing some of the current earnings forecast to be deteriorating as well, and they're actually very stable. We're also seeing a pickup in certain sectors that have lagged perhaps over the last 18 months, given the market's focus elsewhere, healthcare being one of them, and that's an overweight in our portfolios at present. So I think overall, and this possibly hasn't been reported quite as much as some of the other sort of issues that are affecting markets at the moment, perhaps the election as well. Second quarter earnings were positive, reinforced the belief that the overall profit cycle is recovering and growing strongly, and not just for this year, but into next year and the following year as well. So what we have also seen as well is a much wider broadening out of that earnings growth away from just the very focused sort of tech and communication stocks that have led the market over the last 12 months, which is something we talked about in our last call, and we expected it to happen at some point, and we're happy to see it happening now. Just from our this is a snapshot of the earnings reports of the companies that we have in the portfolio, or some that we have on the sidelines. And you can see in green, the actual earnings beat showing up in green was pretty much across the board. Sales a little less perhaps reliable. There's a few companies that missed out on their sales targets. But overall, what was also quite interesting is that people do these counts of how many mentions there are of recessions in earnings calls, and they were at a very, very low level this time. So the idea that we're about to face a recession in the US, I think, is possibly incorrect at present. Just looking at the portfolio for the fund, just to recap for those that aren't familiar with it, the fund is constructed from a bottom-up basis. It's a high conviction portfolio of 30 stocks. We group it into 3 different areas. So our core position sizes are 6 or 7 stocks, all are at around about the 5% level. And all of these companies are constituents of the MSCI top 30 in terms of market cap. The next part of the portfolio are our high conviction ideas, roughly 55%. These are at about 3% position size each, and they include obviously stocks across a wide range of sectors. And then we have a bucket on the right-hand side, which are our tactical positions. These are all at around 2%. They include stocks that are coming into the portfolio, new ideas, but also perhaps slightly higher beta recovery plays and some higher growth, higher valuation stocks as well. We also include there right now our position in the GDX, which is the VanEck gold mining ETF, which we've had since the start of the year, which has actually performed very well for us this year. Looking at the portfolio, I would say that over the last week, 10 of our stocks have made all-time highs, which I think is quite sort of considerable, and none of them are in the Magnificent Seven. And I think that tells a story as well, which is that the broadening out of the market is taking place. There's less perhaps focus on those Magnificent Seven stocks. Some of them reported, slightly disappointing growth rates in the latest quarter, and we are seeing much more interest in areas of the market which have lagged over the last 18 months. So including in those, we've got Marsh McLennan, which is in insurance. Berkshire Hathaway has hit regular all-time highs over the last week. Carrier Global, which is in heating, ventilation, air conditioning. Monolithic Power, energy modulation for AI and data centers, chips, etc. United Health, which has bounced back incredibly well from a little bit of a disappointing earnings in Q1. SAP, Netflix, AstraZeneca, and Coca-Cola and Procter & Gamble. So a very wide range of stocks in a wide range of sectors, which I think, given our approach, which is to have a blended portfolio across all styles and across all sectors, is quite sort of reassuring at the moment. Just on our sector weightings, healthcare we've recently actually added to as well. So our healthcare weighting at the moment is about 15%, so we're about 3% above the benchmark. We've reduced our staples a little bit. We've taken some profits out of areas which have performed very strongly year to date. But overall, apart from our underweight to information technology, which is expressed here, our portfolio at present is quite neutral across across the significant sectors. We do have an underweight to the US market, and we do have an underweight to the dollar as a result. We are overweight to European stocks, European currencies, and this weakness of the currency of the dollar over the last month or so has been quite helpful to us too. Just to perhaps cover how some of the different areas of the portfolio performed year to date. So just referencing Coca-Cola and Procter & Gamble here. I mean, these are two very sort of defensive companies, very low beta. Yeah, we know what they do, and they've done incredibly well this year. Coca-Cola had a great set of results in the Q2. They had 10% organic growth year on year, a 20% jump in global sales of Coke Zero, revenue which exceeded expectations. Some of it came from increased prices across their product range. But also as well, they're seeing now the benefit of a weaker dollar also assisting earnings as well. And they've reiterated their stance on buying back a significant amount of shares. So both have outperformed the MSCI World year to date. They've actually hit all-time highs this week. And we're quite happy having them as constituents of the portfolio in the staples bucket. Tactically, yeah, we've had some good contributions from the likes of Rolls-Royce this year, continuing the recovery from its low point after COVID, the number of aircraft flying, its order book for new engines, etc., all very positive. Meta has continued to climb on the back of some solid advertising revenues, and we scale it as a tactical position because it is quite a high volatile stock, and it is trading on quite a high multiple at the moment. And GDX, which is the gold mining ETF, which we've recently taken profits on. Given that some of the companies within that have, had fantastic year-on-year improvements in their sales and earnings. And actually, just over the last month, for instance, so you can see how markets performed on a month basis. The world index, 1.89%, but quite a significant drawdown. Some of these other tactical plays actually did very well during that period, so they've certainly earned their place in the portfolio as a result. Healthcare is a sector that we have increased over the last 6 months. We've added further to United Health. Novo Nordisk is one of the core holdings there, but also Roche has gone back into the portfolio, AstraZeneca. We switched out of Chugai Pharmaceutical, which is a Japanese pharmaceutical company, into Roche, which actually owns 60% of Chugai. The multiple attraction there was quite important, much lower multiple and an attractive yield, and they own 60% of the company as well. So that was a switch we made during April. And then on the core side of things, well, clearly it's been a very strong year for Berkshire Hathaway, notwithstanding the fact that it has roughly 30% of its assets in cash at the moment. Clearly, the company is going through a period of asset reallocation, which is quite interesting. Selling down their stake in Apple, selling down their stake also in Bank of America. Could be construed as precautionary. Buffett's made it very clear that he doesn't see too many attractive investments in the market right now, particularly in the US. So he's built up his cash buffer to roughly 30% of assets, and yet that hasn't sort of stopped it from moving on to all-time highs. So yeah, it's our largest holding in the portfolio at present, and we're quite happy to see the activity within the portfolio and its current sort of exposure to cash. That's me, Eugene. So I've kept it quite brief so that we can have a few questions if there are any.
Yeah, Gary, thank you very much for that. Really appreciate it. You and I spoke briefly before we came onto the session, and also a question we get very often, just in broad, with regards to gold. Do you have any gold in your portfolio? And what's your views on gold? It seems to be holding firm and prices really high at the moment. What is the story on gold?
Yeah, we've been sort of considering our exposure to gold for some time. We didn't want to hold just physical bullion. We wanted actually to own something which had a beta to that. And rather than selecting individual stocks within that sector, we felt it was probably more prudent to get that exposure through the gold mining ETF. So it's GDX, which is a basket of the largest global gold mining companies, very liquid. I think it's about a $16 billion ETF. Clearly, the gold price has been supported by a number of factors over the last 12 months. There was a lot of buying interest from sovereigns last year. That's possibly been replaced by buying, particularly from China, from Chinese sort of consumers who perhaps are a little bit sort of burnt on the property side of things and on the equity market. They're looking to preserve their savings and diversify out of the currency into a real asset. So that's perhaps replaced some of the sovereign buying. But also as well, clearly, it's an asset which benefits from a weaker dollar-based currency and lower interest rates, which has really propelled it in the last sort of 3 or 4 weeks. And the gold mining shares, having had a period of underperformance, and we saw a big discount in terms of where they traded to the gold price back in February, they've reasserted themselves and they've actually climbed above that now. So the trade itself has been quite profitable. We have taken some profits on it recently. I think for the gold price to continue to sort of climb from here, I think you're going to need more evidence of significant sort of slowdown, perhaps from the US. So I think perhaps some of the strength, some of the running has already taken place in the gold price for the year, other than perhaps some further sort of weak data and a further weakening of the US dollar.
Gary, thank you for that. Question from the audience very quickly. What is your turnover rate in the fund? And what is your volatility or beta versus the benchmark?
Yeah, the beta versus the benchmark is roughly 1. It's roughly neutral. It has changed. We had a slightly higher beta stance in the portfolio in 2022, given that we had more exposure to cyclical sectors. But with the changes we've made and the construction we have of the portfolio at present with the 3-bucket approach and the lower tracking error to the benchmark and lower active share, actually the beta has come down to about 1. Turnover was fairly high at the start of the year because we were making quite a few of those changes to those underlying investments. But since then, it's leveled out. And actually, our turnover now is probably at the lowest level it's been for the last 5 years, roughly at about 30-35%.
But part question from Sean again, and similar to what I asked Richard. I mean, we are spoiled for choice in SA when we look at global equity funds. We've seen a lot of your company over the past 2-3 years. Very interesting indeed. But Sean also asking, what is your edge versus other funds in the category?
Yeah, I'd like to think that our edge is in the fact that we do our own research. We start, from a clean piece of paper on every company we look at. We have a defined process for screening those companies to arrive at the list of stocks that we feel merit inclusion in the portfolio. But we don't sort of count out any sector. We're not discriminating against sectors. It's a blended approach to investing. We use the macro overlay to help lead us in terms of positioning into sector relative to sector, some of the macro exposure in the stocks as well. So I would say we try and build a portfolio which is relevant for all parts of the investment cycle, but without being a CTA or an active trader to that respect, and having currently a core holding to the main constituents of the index as well, which we clearly it's an index driven market, it's a momentum driven market at the moment. So we're cognizant of the fact that we need to be anchored to that benchmark at all times, but having enough ability alongside that to generate alpha from our sort of conviction ideas.
And it's exactly that slide you've got up at the moment. It does speak to what you say you do if you've got your core holdings. But if you look at the conviction and tactical ideas, a lot of it's stuff very different to a lot of managers out there. So you are getting good diversification in this portfolio from what clients are typically used to. Gary, thank you so much again for joining us this morning. It's always great to have you on these sessions. And again, we'll also get hold of you in the near future to give us an update on Martello and what you're doing.
Thank you, Eugene. Appreciate it.
Thanks, Gary.
Cheers.
Good stuff. Right, we are moving on to global property, and we've been advocating that global property is a good diversifier for returns, and it is geared towards a rate-cutting cycle. And look at July. I mean, the returns was just absolutely significant. Joining us as the expert on global property, you're all familiar with Greg Rawlins from Reachway Global. Good morning, Greg. How are you doing?
Morning, Eugene. Pleasure to be on screen with you.
Always great to have you. And Greg, I see for July, you are right on top of that stage or the tin. So you had a magnificent month. I think a lot of clients want to know, was this the beginning of the end or the beginning of a lot more great results from global property? Let's see.
Eugene, I'm actually struggling to share my screen with you. Just a second.
Greg, if you want, if you're struggling, we can drive it from outside. Yeah.
Let's try again. There we are.
Yeah. It's coming through.
Okay.
Got it on. Yes.
Thank you.
Presentation mode. There we go. You've done this before.
Okay. Great.
Perfect.
Thank you. Eugene, the last 2.5 years hasn't been rewarding to REIT investors. And for half of that period, it has been frustrating in that we have seen most of the subsectors making up the REIT sector delivering real compounding returns, but the market has just ignored it. I think mainly that it has been fixated on the tech sector. However, I'm pleased to point out that things have changed, and to that effect, we've broken out of the 2.5-year trading range at starting in 2022, and at last there has been a recognition by the market. I don't see it as a rotation, but rather a broadening of the market. And what supports this is on really substantial volume as well. So it looks as though it's sustainable. And let's have a look at this period in the bigger picture. We have been showing this chart for a number of years now, and going back to 2000, global property has been outperforming global equity. And that is on the back of an increase in the number of sectors. It was way back in the late 1990s and the early 2000s when I was first started analyzing and investing in REITs, when there was barely a handful of different sectors. Now there's more than 30 and increasing, and stop counting. So we've got so much opportunity to create portfolios that deliver a total return, a desirable and exciting total return. So as you can see, there's quite a bit of catching up, and this is the current opportunity that we want to project to investors. What we have done, let's dig into this data a little bit more deeper. And what we have done here is we've plotted the global property index in orange against the MSCI GDP index. And I just want to initially exclude what has happened since 2022. But if you look at the left-hand side, you can see there's a strong correlation between global property and global growth. However, let's have a look what happened in this divergence in a little bit more detail in this period in 2022. Unfortunately, this data only gets updated on a monthly basis. But if you want to destroy property value, sprinkle inflation on top of it. So as much as investors see and talk about interest rates affecting property values, high interest rates and usually comes with fighting inflation. And as you can see, this convergence has started. And inflation has stabilized to a degree. Looks as though it's going to go down slowly, and this is all very good for property. So it is the smart investors, as we pointed out in the earlier chart, who are positioning themselves to avail themselves of this changing environment, particularly for property. So that is the data. Let's get into the fundamentals. And one of the detractors is the commercial property, which is aptly described as a slow-moving train wreck. But let's break this open and see exactly what the media in particular means about commercial property. Well, using the US as a proxy for the rest of the globe, commercial real estate in the US has got a market capitalization of approximately $21 trillion. Of which $2 trillion is the REIT sector. So getting more specific, commercial real estate is privately or directly owned to let property that excludes listed REITs and residential property. Of that, about $19 trillion of market capitalization, 40% is the problematic office sector. Now, in the US in particular, let alone the rest of the globe, there was just too much office space prior to the pandemic. And really the pandemic just expedited their position and exacerbated their position. And the result is there is just vast acreages of property, office property that cannot be reused or repurposed. And much of this debt is held by the 4,000 regional banks, and even some of the larger banks have got of course, a lower position exposure to this property. As Jay Powell described it, it is a problem. And however, he says that his view is that it's manageable. But the reality is a lot of this property cannot be repurposed, although some of it can, in the form of, in most cases, apartments. But invariably, the owner has to take a significant write-down in the value and incur a significant amount of capital to make it worthwhile. The remainder is the value of the property is nothing more than the land that it is on, net of the demolition costs. And a lot of it is in decaying city centers. And yes, it's not just in South Africa where we have decaying city centers, but in the US as well. So this is a slow-moving train wreck. It's already started over the last year, and we expect it to continue for the next 2 years. And it is the regional banks that are having to take write-downs on their loan values, and of course the owners. From the REIT sector, I'm pleased to inform you that according to most metrics, the REIT sector, the offices make up approximately 5% of the overall market capitalization, and I've seen some metrics actually recording this as 3%. So we as portfolio managers can avoid this sector in its entirety, should we want to do that in our portfolio construction process. So let's get into the more positive aspects of global property at this point in time. And we have been, over the last 5 years in particular, been at pains to point out to investors that it is no longer a monolithic asset class. So to depict this, what we have done is we've constructed 2 indices by extracting 12 bond-like REITs and 12 equity-like REITs that have been in our portfolio or currently in our portfolio, and equal weighted them. And as you can see, different results were delivered. Just with regard to the bond-like REITs, they are the ones with long duration rentals north of 5 years up to 25 years. And so long as the covenant is in place, you can actually predict what you're going to be earning in 10, 15, 20 years' time. So they're very much in tune with the bond market. There's a strong correlation with the bond market with these assets. I must just point out that we have been slowly increasing our exposure to these REITs in anticipation of a rate decrease. Let's see what Jay Powell has to say on September the 18th. But these REITs perform well in a declining interest rate environment. Obviously, the converse in a rising interest rate environment. Further, equity-like REITs are the ones that are attuned to the economy. And as expected, with the increasing number of these sectors becoming available, it's outperformed the bond-like environment REITs over this period starting in 2011. I personally see a third type of or category, and that is the REITs that are immune to the interest rate or the economic activity. And 2 examples are, for example, the tower REITs, which for 15 years, up until about 3 years ago, continue to deliver stellar compounding growth, irrespective of the economic conditions. And of course, now the data centers, they've got a new category creating demand for their resources and their properties. And that is AI, which are requiring vast amounts of storage facilities for the processors and, of course, the data. Let's not go too far away from what I'm trying to articulate here, is that the REIT sector is no longer monolithic. And I must point out, for example, that this by sheer chance and random walk, these indices outperformed our global property index by a significant margin over this period. Taking this further, I alluded it to earlier on in the presentation, that it could be fair to say REITs have been caught up in the growth over the value trade, which has been dominating the equity markets. So let's have a look at the positive fundamentals supporting our view that we see an inflection point. We've already seen a pivot, and that is the REIT prices have already corrected and taken into account the new real interest rates, which we expect to prevail for the foreseeable future. We've had almost 2 decades of not normal interest rates. And so the pricing, the valuations for REITs have taken into account, if anything, it is our view that they have been oversold. Further, REITs balance sheets are in great shape. The US REITs, for instance, and to that effect, Canada and Australia, their average debt level is a commendable 30%. In the UK, this is about 35% after coming down from 40%. So they're in a very good position. However, in Europe, this is still far too high at 40%, but it may sound counterintuitive here too. We've been increasing our exposure to these European REITs in anticipation of rate cuts, as they will do very well in a declining interest rate environment. Further supporting our position that we are at an inflection point, as visible by the pivot, is that in most sectors, the overall vacancy rates are low, and the rents, the REITs have pricing power in terms of rental growth, which also supports another supporting view as to the prospects for at least the next 3 years, is that property development is currently uneconomical. We are still in a high interest rate environment, albeit that we expect it to start decreasing in the near future. And also, we have wage inflation, and it's just too expensive to take on and too risky to take on major property developments. So if you're holding property over the next 3 years, the REITs are well positioned, as their prices are attractively priced relative to their replacement costs. So those are those fundamentals supporting our view that investors should be increasing their exposure to global property. Finally, we expect sentiment will turn for the better, albeit that it is data dependent, and it's arguably already starting to happen. So in conclusion, I'd like to quote David Auerbach of Hoya Capital, who is often interviewed on Bloomberg and CNBC, and has been a close associate and a friend of REITway for over 10 years. In his recent interview, and I'll quote, he mentioned that when the Fed announces the first rate cut, it will be literally seconds later that the REIT sector will respond. And he's implying that there's a current opportunity, and it'll be too late, as that ship would have already sailed. So in conclusion, and we concur that it is our job to educate investors and advisors to increase their position of REITs for what is the inevitable that is coming down the road, and it could be as early as September the 18th, when the Fed makes its next rate decision public. Thank you.
Greg, again, a very compelling argument for global property, and now more so than ever in educating all of us for that. Thank you. Only one question for you. I do buy the argument on global property, and I've bought into that for some time, and I think some of the audience as well, and it's paying off. But my question is, why would I up global REIT exposure relative to global bonds?
Well, if you recall, I showed two separate broad categories. One is equity-like, and the one is bond-like. Yep. So firstly, just remember, bonds are invariably have got fixed yield, fixed returns, whereas the REITs, the bond-like REITs, have got growing earnings. So that is a differentiator if you want to compare exactly one with the other. But the vast majority of REITs now are equity-like in their behavior in any case. And we believe that they have been oversold just like the bond-like. So across the board, we expect it to outperform bonds over the next 3 years.
Just a lot more oversold. Exactly that. Very last question from the audience. What are tower REITs? Is that cell phone? What is that?
Yes. Okay. No, it's not office towers. No, most of them need to be demolished, but it is the communication towers which transponders are placed on them and transmit 3G, which is out of date, but 4G, 5G communication, cell phone signals, as well as many other types of telecommunications. And it's a fantastic model in that you build one tower and you festoon it with numerous transponders of numerous clients. And incidentally, they take out long leases anywhere between 10 and 25 years. It's a fantastic model to invest in. So that's what I mean. That's what I should have called it, as communication towers.
We got that. Fantastic opportunities indeed. Greg, always great to have you with us. And thank you so much for your time again this morning. But we'll see you in the next couple of weeks as well on the road. Looking forward to that.
Thank you.
Thanks a lot.
Bye.
And we are moving on to global emerging markets. Joining us now all the way from London is Lars Achenbuch from Riskera, managing the Riskera BCI Emerging Markets Equity Feeder Fund, but they've got the real McCoy in USD on the other side. Lars, very great to have you joining us this morning again, unpacking emerging markets and where you do see the opportunities. I must admit, if we look at emerging markets over the past 5, 6, 7 years, it doesn't sit very nicely. A lot of volatility, so I think a lot of people are skeptic about emerging markets. But as the tide is turning, we all heard about rate cutting cycles. We spoke about it endlessly this morning already. Is it turning in favor of emerging markets?
Yeah, absolutely. Good questions, Eugene. Good morning, everybody. Thank you for joining us today. And I appreciate some of you would have been on the similar call probably about 6 months ago. So I thought I'd actually just start off by recapping the case for EM and sort of comparing how we've ended up a little bit today versus where we were earlier in the year. So the overall case for EM is still exactly the same one, right? It's got huge population. It's growing strongly in aggregate, both population and economic output-wise. Typically much lower debt levels than in the developed markets. Commodity prices, when they do go up, does well for EM. That's a big diversifier. We've got an example or two of that coming later on, and some quite exciting underlying stock picking opportunities. But on the next page, we see that there are clearly some issues that hurt emerging markets, and in particular, I draw your attention to numbers 2 and 4. Higher interest rates, as Eugene, you said, we've spoken about that at some length today already. But basically, high interest rates and the resulting strong dollar are bad news for EMs, generally speaking. And that's because most emerging markets run a current account deficit. So they import more than they sell, and they then need to make up that difference by having capital flow into the country. And that becomes less attractive if the source of that capital, typically the developed markets or the US, if rates are high there, then it's more attractive to keep your money at home. You don't tend to send it abroad into the emerging markets. So that becomes a bit more tricky for the EMs. And very recently, we've also had a spell of risk-off sentiment. You'll probably remember the beginning of this month. We'll return to that in a little while. But in times of risk-off sentiment, EMs typically do poorly, but actually there were some diversification issues that we did identify earlier. So on the next page, I've just had a quick summary of how is 2024 working out for emerging markets so far, and the reality is they've lagged the US equity market almost like any other place across the world, and that US equity market, let's bear in mind, has been driven up primarily by the Magnificent Seven, as people call them, the collection of technology stocks that really have driven valuations as well as the market performance of the US equity market. But just as an example, I indicated, if we think back to the beginning of this month, there was a very significant derating or even a mini market crash in Japan. And during that time, actually, emerging markets demonstrated their ability to act as a diversifier. So they fell as well. Once the US market falls, all markets tend to fall together. but they fell by less and they recovered more quickly, particularly when compared against the NASDAQ index, which is the very tech-heavy index. Japan had, I think, its biggest negative day since the October 1987 market crash earlier this month. It has recovered since, but I thought it was a bit ironic that the Financial Times on the day said something like Japan is trading like an emerging market, forgetting that in fact emerging markets did slightly better during that period than the Japanese market did. But then again, the FT does have a quite jaundiced view of emerging markets in general, and China in particular. Don't believe everything you read in the FT. I know it's a respected publication coming out of London here, but they do have a bit of an agenda. So that was a bit ironic to have them say that. And certainly through the year to July, as I said, developed markets up about 14%, most of it driven by the US tech sector, whereas your EMs have been more muted at 8%, and that's held back principally by China, which is, the return is not actually 35. There is a dot in there. I'm sorry, it doesn't look very good on my screen. 3.5% increase in the returns of China. So on the next page, I just updated quickly a slide that we showed back in February as well. This is the relative market prices of EM versus the DM. So when the line is reducing, then it means that developed markets are doing relatively better. When the line is increasing, then EMs are doing relatively better. And what we're looking at now is that there hasn't been a significant difference since we last spoke. The line is kind of flattened out a little bit if you look at the very last, the edge on the right-hand side. But we are kind of bouncing along levels that we haven't seen since the 1997 Asian financial crisis, the 98 Russian crisis. So we definitely are at levels that we haven't seen for quite some time. And actually also interestingly, if you look back the last time we had valuations like this, yes, there was that Asian crisis, but also there was a tech bubble in the US. So that coincides with if you look back there, 99, 2000, 2001, that little window that coincided with the famous tech bubble back in the early 2000s in the US. Question mark, are we in a similar situation today? But irrespective, we are certainly at levels that we haven't seen for quite some time. And then on the next page, you can see what that means for relative valuations. So the orange line in the bottom is the forward PE multiple for the EMs. The dark blue line on top is the DMs, and that relative valuation has actually widened a little bit since we last spoke, on the back of particularly the AI frenzy. So the stocks the likes of NVIDIA that have done extremely well in the US, they have driven up valuations for companies in that market. They've dragged a couple of other companies with them. And so if you kind of ignoring the COVID period, because that was a bit unusual, earnings were significantly reduced there, so all forward multiples were elevated for no reason. But if we can strip out that period, you look back over the last 20 years or so, we haven't really seen valuations in the US as aggressive as they are today. So all of which speaks to the possibility that we may well be in for a bit of a correction here before very long. We've touched on interest rates already, and yes, that the thematic of US interest rates being higher for longer has been unhelpful for EMs. But on the next page, we can actually see that among emerging market countries, the rate reduction cycle is already well underway. If you look at the light blue line, for example, that's Brazil. They've already started reducing their rates. The Chinese have gently been reducing their rates. That's the slightly difficult to see. It's a purple line that sort of starts halfway through around about 2014. So that's been going down. Ignore the gray one, that's Russia. They have their own set of unique circumstances there to do with sanctions in the Ukraine war. So their monetary policy is not quite in line with everybody else. But certainly interest rates across the EM markets have been able to be reduced. And a lot of that is down to the fact that your emerging market countries simply didn't have the same inflationary issues as were experienced in the developed markets, either because they are themselves commodity producers, so perhaps they weren't as impacted by the oil price increases when the Ukraine war started, or because they did deals with Russia and they've been buying cheap oil off the Russians ever since. So this interest rate cycle is very much a little bit decoupled in EMs. But having said that, the biggest driver will and continues to be what happens in US rates. And even though the speaker we just listened to now, we mentioned that the US Fed has started saying, well, maybe it's about time to start reducing rates. They've got a big meeting coming up next month. Let's see what happens. So, if you're an EM watcher, if you'd like, positioning is in advance is what you're trying to do, then you need to be ready. You need to have your finger on the trigger here, because it's going to move quite quickly when those first rate reductions start coming through. So let's have a quick look on the next page at a couple of individual countries to see who's done well and who hasn't done so well. So among EMs, the countries that have been successful, market-wise at least, as well as GDP-wise over the last 6 months, but longer, India, South Korea, Taiwan. I've just highlighted a couple. In India, Rajendra Modi was re-elected for, I think it's an unprecedented third term, favorable economic backdrop. There's been a lot of corporate reform there. The economy is doing well, but Indian companies are trading at very rich valuations. And so, in fact, a lot of the managers in our EM program have been reducing exposure in favor of more attractively valued companies elsewhere. India may continue to do a little bit better for the very short term, but like all things, eventually a high flyer will come back down to earth. South Korea benefiting from some corporate reforms, which is just encouraging more efficient management of companies. Taiwan has been driven strongly by TSMC, that's Taiwan Semiconductor Manufacturing, who finally has sort of caught up in the AI and semiconductor wave. They were, for various reasons, not benefiting so much initially. I think they had some production issues that were a problem, but they've got it together, and now people are saying, well, actually, if Nvidia is doing so well, eventually TSMC will also come up with chips that are extremely important and useful in the whole AI and data center world. On the next page, we're looking at some countries that have done a little bit less well, and China, top of mind. It is the biggest single member of the EM index. It did recover off its 2023 lows, and we spoke about that back in February for those of you who were on that call as well. A lot of the themes, unfortunately, continue to be the same. So the property sector is still dragging, and consumer confidence is not as great as it could be. Policy responses have been shallow and somewhat ineffective, and one could argue that many of the problems in China have essentially been self-inflicted, that policymakers are simply not being decisive enough. They've been piecemeal, a bit hesitant. They've been talking at responses rather than actually putting them through, I guess, hoping that the talk will be enough to influence the real world. But that hasn't necessarily filtered through. Certainly, there's been a lot of effort in China on the supply side. So inward substitution of high technology industries. The electric vehicle sector has been in the news for quite some time. China now the world leader in electric vehicles by some margin. But then there's, on the flip side, accusations of overcapacity on that front. And certainly a lot of developed market countries are quite afraid of that, and have started slapping very large tariffs onto Chinese electric vehicles. So sort of interesting to see what will happen there. Certainly this inward stimulus has worked, but it's not entirely without its issues. Latin America, Brazil, Mexico in particular, both have had elections. Both have seen swings leftward in their governments, or the retention of Mexico's case. Claudia Sheinbaum is basically the continuation of the policy that the previous president Andres Lopez introduced. But Latin America continues to have very attractive underlying companies. A lot of companies that are quite innovative. Mercado Libre, we've spoken about before. It's essentially the eBay of Latin America, which has done extremely well. Nubank is the largest challenger bank in Latin America. It's Brazilian-based. But Latin America does have a lot of cyclical industries, lots of commodity production, in many ways quite similar to South Africa. And the politics is something you can't entirely ignore. Obviously, if there's a weak political regime or an ineffective or unhelpful regime for corporates, that is going to weigh down on earnings. It's going to weigh down on the markets. Let's just have a quick look at geopolitics on the next page in a little bit more detail. The US election is coming up in November. Both Republicans and Democrats are quite overtly anti-China. In particular, if Donald Trump wins, then it's likely to have a much more severe impact on onshoring or the imposition of tariffs. China, meanwhile, has been moving quite steadfastly on its self-sufficiency track. If you look on the chart on the right-hand side, that's looking at academic work and research work. It's counting the number of patent applications. It's counting the number of high-impact academic papers. In both top and bottom, China is the dotted line. And you can see, particularly on the patent application, an incredibly large explosion over the last 10 years, 15 years of Chinese patent applications for technology. The Chinese are playing massive catch-up. And this has got the Americans frightened. Right? They're seeing their competitive edge in technology, economically, being threatened, and that's an uncomfortable situation to be in. And as a consequence, one sees this sort of geopolitical tension coming through. The chart on the bottom is the trade balance, China being the biggest trade surplus with the US. Donald Trump certainly has adopted what they call a mercantilist approach. So he sort of views a trade surplus with any country other than with any foreign country to be that foreign country exploiting the US for its own gain. He doesn't really understand that there will be benefits to both sides. But one thing to remember, even though China on this chart is the biggest in dollar terms, it is not by any means the biggest in percentage terms. So that trade surplus only represents around about 3% of the Chinese overall GDP, because China is simply very large. So even if there are tariffs, the impact on the Chinese economy is actually not that enormous. Mexico, for example, is in much weaker position. Even though, again, in dollar terms, it's less than the Chinese. It looks like about somewhere between a half and 2/3 of the Chinese surplus. But in Mexico, it makes up something like 29% of the overall Mexican GDP. So if there are tariffs, if there is a geopolitical concern with Mexico, it is much more at risk than China is, for example. And indeed, if you remember back to the first Trump presidency, he did go around renegotiating the NAFTA, the North Atlantic Free Trade Agreement between Mexico, Canada, and the US. And so Mexico is in his crosshairs. And of course, Mexico is also a source of a lot of the immigration issues that are annoying and upsetting American voters. So Mexico is probably the country that's most at risk of geopolitical issues. Vietnam also makes a lot of clothing in Vietnam, gets exported to the US. It's on currency watch for the Americans are concerned that the Vietnamese are manipulating their currency so as to remain competitive. So there are some countries that are much more at risk of geopolitical issues than the Chinese. But China, simply because of its size, it's the thing that ends up in the news. So anyway, moving on swiftly, the next page, what's in store for EMs going forward? We've spoken about the higher for longer interest rate strategy for some time. The markets of Latin America are quite susceptible to that. Domestic political issues cannot be ignored. So in the short term, I think we would expect to see a bit more volatility up there, especially in the run-up to the US election. But longer term, it's strength in natural resources, structural attributes, digital innovation is remarkably strong in Latin America. And these will be significant traits to create long-term investment opportunities. And at the end of the day, the markets are cheap compared to other regions. So, if you're a patient investor, if you're taking a longer-term view, it's the place to be. Growth forecasts on the next page, just very quickly. I appreciate we're sort of bumping up to time. India, China, these are still going to be the growth hotspots for the next 2-3 years to come. Russia has done surprisingly well, but we expect that to slow down. Sub-Saharan Africa, unfortunately, South Africa is still looking really pedestrian. No really good news there. On the next page, just recapping very quickly two of the crocodile draws that we spoke about in February. On the AI side, the US Nasdaq 100 has continued to be very strong. Beginning of August, there was the first signs of a crack, but it has recovered since then. But the valuations are super stretched, and it simply is unsustainable. And the second page, the next page is India versus China. India's had a big boost from its politics, from the re-election of Modi and his party, but the valuations are likewise expensive. And as I said earlier, our managers in our program are just avoiding India now. It's just become too expensive. So to close on the next page, developed markets, mainly the US tech stocks, have continued to outperform. So on the next page, guys. Relative levels of EM pricing is approaching the troughs in the late 1990s. Rate cycle, spoken about already, and when that rate cycle starts to turn, that will lead to a significant change in the environment. EMs are likely to outperform. If you're a medium-term investor, you need to be sharpening your pencil. You really, really want to start getting into some EM exposure now to be ready and in place for when that rate cycle starts turning. Once it happens, the chances that you probably miss it. Thank you.
Lars, thank you very much for that. Insightful indeed. That one of the charts you showed was the valuations between China tech, US tech, and it's very clear those valuations are very stretched. What will unlock that China tech to actually start kicking into gear?
So the Chinese technology industry is actually doing quite well. So if you look, on the ground, the companies that are operating in that sector, the innovations that are coming through with, if anyone who visits the Chinese, mainland and tours around some of these companies comes away blown away by how innovative these guys are, how quickly they can scale up, etc., etc. So the issue is actually it's a sentiment and valuation issue. So on the one hand, the US market is super expensive, and we've spoken about when that might turn. And I dare say that's also interest rate sensitive, right? People have just extrapolated earnings at low interest rates for a very long time into the future, that they come up with these extraordinary valuations, and that that's unsustainable. And the sentiment against the Chinese on the flip side is quite negative. So it's a sentiment will turn that around. It's not an on the ground issue. The companies in China are doing very, very well. Thank you very much.
Lars, thank you for that. I want to get into your fund very, very quickly, because you do run an interesting fund. It's a multi-managed strategy, right? So my question, and we did speak about how you manage your strategies, but maybe just for a very quick recap, how do you manage this fund, and where do you find the managers that you populate to get the EM exposure?
So the fund that we have, the benchmark is the emerging markets index overall.
Yes.
And when picking the individual underlying managers, we are looking to find essentially best-in-class managers across the various EM regions. All right, so we try to pick someone who's a Latin American specialist, pick someone who's a China specialist, pick someone who's great, let's say in Eastern Europe, and then you by the time you're putting it all together, you then say, where are our geographical over and underweights? Is there anything there that we're uncomfortable with, because we don't want to be unduly exposed? We may use some ETFs, for example, to kind of top up a weighting if everybody's look-through portfolio has been quite negative. But we're trying to create a relatively all-weather portfolio that covers all the opportunities across the without being unduly beholden to any one manager's process or value versus growth. We're trying to eliminate those sort of biases from the portfolio. But really, the trick is to try and find the top quality managers, the best in class managers in the EM regions, and put that together into a portfolio. And let me, it's done very nicely. Thank you very much. There's positive alpha since inception against the index, so the strategy appears to be working.
And it adds to the diversification of the overall fund. Exactly that. Lars, if I look at the comments coming in from the audience, there's clearly a lot of interest in your strategy. The clock caught us. I'm going to send us through to you, Alex, Andrew. We'll get some comments on that for you, and we'll get you in touch with Lars as well. If you want to have further conversations on the fund and what they do at emerging markets. Lars, again, from our side, thank you so much for dialing in today from London. Grateful for your time as always.
Thank you very much.
Right, for our last session of the day, but definitely not the least, is Simon from Contrarius. Simon, thank you so much for joining us this morning all the way from Jersey. I believe you and Gary are possibly going to have coffee after the session and talk about this.
Maybe. I'm
Me-
sure we can have some interesting debates. Thanks, Eugene. It's great to be here. Dan, if you
I'm
could
sure.
maybe skip through the first few slides. There are a lot of disclaimers.
And get into the meat of things.
I'll jump straight in, Eugene, if that's okay.
Thanks, Simon.
So we normally start our presentations with our performance since inception. This shows the MSCI World Index. Dan, the next slide, the next line shows if you could just, there we go, the MSCI World Value Index in green, which of course has underperformed the World Index. The flip side of that, of course, being the Growth Index, Dan, which is the orange line, I believe, has outperformed the MSCI World Index. We also show the average manager in black since we started our fund, and you can see that has also underperformed the World Index and performed pretty much in line with the Value Index. And then the blue line, Dan, which is us, is the performance of our fund, which you can see has done pretty much probably just below the World Index, just below the Growth Index, pretty much in line with the World Growth Index since inception. But the one thing I maybe will say is that when you look at that blue line, our recent performance has been very disappointing. We've gone sideways, whereas other factors, whether you look at growth or value or the average manager, have gone up. And I think to add insult to injury, we've actually had quite a high degree of volatility. So you can see that blue line move up and down quite a bit, which has, of course, made it even more painful for our clients. We fully understand that. We're a staff-owned business. We are significant investors in our own funds. We're amongst our own largest clients. So we have substantial skin in the game, and we really do feel this. I guess the only assurance I can give is that we believe that our portfolio is full of very cheap shares that have only gotten cheaper as the market has become more expensive. It's hard to predict when the value inherent in our shares will be recognized by the market. Sometimes it can be very difficult to take a long-term contrarian view. But I guess times like these, it's especially important to be patient. If we go to the next slide, Dan, I'm going to discuss one of those opportunities in a lot of detail, and that's Tesla. It's the largest share in our portfolio. It's also the most controversial. In fact, we get asked more about Tesla than about probably all the other shares we own combined. A lot of people really don't like Tesla. Elon Musk himself is a very polarizing figure. Last I checked, the short interest was about 4% of the company, which means that there's over $20 billion currently betting that the share would fall. Now, the share has already fallen by almost half from its peak of over $407 a share about 2 years ago. So from a sentiment perspective, and when I look at what our peers own, I would say that this is a pretty contrarian position, and it's fully consistent with our philosophy. The next slide, Dan, shows the share of electric vehicles as a percentage of the overall market. And you can see that electric vehicles, and these are battery-powered electric vehicles, excludes hybrids, are growing their share quite strongly at the expense of internal combustion engines or ICE engines. This trend, we believe, will continue for the following simple reason, and that is that electric vehicles are up to 4 times more energy efficient than internal combustion engines. In other words, between 80 and 90% of the energy stored in an electric vehicle is converted to power the wheels, versus between 10 and 12%, or maybe 20% for an internal combustion engine. And remember, this is still a very new technology. As it improves, we believe this 12% will trend closer and closer to 100%. So that's a massive tailwind for Tesla. Of course, we fully expect Tesla's market share to fall. In the US, for example, Tesla's market share is almost at 50%. But that's okay because the market is going to be growing extremely rapidly, we believe. And importantly, the growth in Tesla's EV business doesn't cannibalize Tesla's other businesses. If anything, it reinforces their other businesses. Tesla's a pure play. So if we take, for example, VW, okay? VW is probably on 4 times earnings. So it looks crazy cheap on the face of it, okay? But for every EV that VW sells, it sells 1 fewer internal combustion engine, right? So it's eating itself, it's cannibalizing itself. If you contrast any Tesla factory to, let's say, VW's massive factory in Wolfsburg in Germany, you would think that they are building a completely different product. An internal combustion engine has more than 2,000 moving parts. An electric vehicle has 90% fewer parts. Now consider that VW employs 116,000 people, okay? What are you going to do with all these people? Most of your staff are redundant. But now the state of Lower Saxony owns a 20% voting share of VW. Would they allow large-scale unemployment? We know that labor laws in Germany are insanely rigid and protective. It's actually even more hopeless. Companies in Germany are run by a supervisory board. Now, VW's supervisory board has 20 members. 2 represent the state of Lower Saxony. 7 represent employees. 3 represent the trade unions. Okay, only 8 of those 20 members of the supervisory board actually represent minority shareholders. It's hard to see the supervisory board ever allowing a large-scale restructuring. So my point is that one has to be very careful to not be seduced by a low multiple. On the automotive side, Elon's done a great job. The Tesla Model Y was the best-selling car in the world, including internal combustion, across hybrid, everything, and battery electric in 2023. In 2015, for example, Tesla produced 50,000 cars. Last year, they produced more than 1.8 million. So they've grown more than 36-fold in those years, which is absolutely astronomical. And they did that without advertising and by selling only through their own channels. On the next slide, I think, is the bit that we are most excited about. I think the real value in the share lies in its full self-driving capabilities. And I wish I could show you a video, but you can Google those. Tesla's approach to FSD is absolutely radical. Okay, they've thrown out most of the code and the maps that their competitors like Waymo and Cruise use. And instead, they've built a neural network which trains itself to drive using real-world video images that are captured by the 8 cameras that every Tesla is equipped with, in the same way that us humans learn to drive, through observation, by observing how others drive. The benefits of this is that, firstly, it's massively scalable. Okay, so it can be deployed anywhere in the world. It doesn't need high-definition maps. It doesn't need LiDAR or radar. It doesn't need thousands of programmers writing code, instructing the car to drive. The second benefit is that it gets better and better with every mile it drives, as it learns to better respond to infrequent events. Okay, so the top little chart there shows that Tesla's already driven 1.6 billion cumulative miles, and it's growing exponentially. The software releases are over the air, a little bit like your iPhone's operating system. Tesla's investing massively in its training capacity. And that's that bottom chart there. Its GPU capacity is set to almost triple to 90,000 units by year end. Now, bear in mind that if you are currently lucky enough to be able to get your hands on an NVIDIA H100 GPU, okay, that's a big if because the order books are completely full. Each single unit costs you more than $25,000. Okay, Tesla's going to have 90,000 of these by year end. So Tesla's lead on the competition, we believe, will only grow. Eventually, Tesla's FSD will become better than the best human driver because it has 8 cameras as opposed to 2 eyes. It doesn't get tired. It doesn't get inebriated. It doesn't get distracted. In fact, according to our data, Tesla's FSD is already quite a bit safer than an average human driver in terms of the number of accidents per, let's call it, million miles driven. So I think this is a real world use case for artificial intelligence. It's not some pie in the sky stuff It's a specific use case for AI that's actually happening as we speak. Hundreds of thousands of cars in the US are using at least parts of this every single day. Okay. So to me, this is one of the most realistic and obvious use cases of AI. Sort of how I think of AI is that you've got two sets of problems, finite and infinite. Chess, for example, is a finite problem. So is autonomous driving. Okay, it's got a lot more variables than chess, but it's finite. And I think AI will be extremely good at solving finite puzzles. The infinite piece, which is general artificial intelligence or something like that, of course, will take a lot longer and will be much harder to fix. We think Tesla is so far ahead of the competition that eventually other car manufacturers will just license their technology from them, just like they're currently lining up to license Tesla's charging standards and infrastructure. And then the more cars you have on the same network communicating with each other, the safer for all road users. So it's a sort of a virtuous cycle. And of course, then you'll be able to use your Tesla car to put into a robo-taxi to earn you money, a little bit like an Uber, but without the driver. And Tesla will get a share of that. So that's very high margin recurring revenue. On the next slide, I mean, I haven't even mentioned Tesla's other businesses, okay, which include solar, include energy storage. Its non-automotive businesses made up almost $1 billion in gross profits over the most recent quarter. Okay, its total energy deployment and storage across its Powerwall and Megapack businesses grew by more than 250% year on year. And I haven't even mentioned Optimus, which is on top there. That's Tesla's humanoid robot. On the next slide, Dan, two of those are currently slaving away on the Tesla factory floor. Okay, by the way, these robots, and again, you should Google this, have the dexterity to crack an egg with their hands. It's actually quite remarkable. So you could argue that Tesla is actually more of a leading robotics and AI company, whereas most sort of industrial analysts, unfortunately, lack the imagination to appreciate this. And that brings me to my last slide. Our portfolio is not only growth stocks and Teslas. Yes, we do have Tesla's our biggest stock, and we are very excited about it. But we also own some pretty deep value opportunities. You'll see there number 2, number 3, Warner Brothers and Paramount. You'll see Alibaba, JD.com, and Baidu. We've had some commentary on Chinese shares, specifically Chinese tech shares. We couldn't agree more with what was said in prior presentations. We think those shares are very, very cheap, low single-digit multiples, lots of net cash, strong reinvestments. They are still growing. We think the outlook is bright for those shares. And then we've also still got Amazon and Meta in our top 10. So there's some overlap with the world index, but really a sort of a hybrid of growth and of some pretty deep value. So I'll maybe conclude on that. We are pretty excited about the future for the shares that we own in our fund, despite the fact that over the last year or year and a half or so, it hasn't really panned out as we would have thought.
Simon, thank you very much for that. There's a couple of questions coming in from the audience. I'm going to get to that now, but I want to continue with that last statement you made. And you know, there's no question that Contrarius, you are running a great outfit. Tremendous amount of skill in the business, you and your team. Your returns from inception are remarkable. You've shown dexterity throughout different cycles and time and how your strategy works. But you had a tough year. Talk us through the 12 months and how you decide to, or your thinking process when things are not working according to what you would think they would work. What is your process in the background to hold on to a lot of these companies, and you're thinking, you know, the payoff profile for clients, how that will come through?
I mean, at heart, we are fundamental stock-specific bottom-up investors. So what we spend all our time on are the fundamentals of each of the businesses that we own. If there's a massive change in the fundamentals, we compare that, we go back to our thesis, we compare it to what we originally thought, And if things aren't panning out the way we thought, or we made a mistake, let's say, because we are dealing with an inherently unpredictable future, we are pretty ruthless in cutting our exposure to that share. And we've done that numerous times in the past. I mean, we've had Lyft, for example. We've had, several companies that were popped into our top 10. They reported a set of results. Snap is another classic example of a company that we recently, was in our top 10. They reported results. Things were actually very different to what we would have expected. We sold the share completely out straight away, overnight. Now, the businesses that have hurt us the most, in fact, are the sort of the deep value kind of, the Paramounts, Warner Brothers, Discovery. So those are companies that are transitioning from a traditional old linear way of, consuming digital media, consuming entertainment towards a digital way of streaming sort of your programs, your channels, and all that. And I think the transition is probably more difficult and has taken longer than certainly I would have predicted 2 years ago. But I think things are happening slower than we would have thought, but things are moving slowly in the right direction. So their streaming customers are growing. They are managing to monetize their entertainment sort of spend more and more and more. But it's happening a lot slower, and the competition from the Netflixes and now increasingly the Amazons and the like is probably stronger than we would have predicted. But those shares are down so much. I mean, some of them are down 90-95% from their peak, and their peak wasn't too long ago. That as we recalibrate our fair values, we still see significant discounts to from where the share price is to what we think the business is worth. And we think now would be the wrong time to sell. In fact, for a company like Paramount, I mean, and you've seen the media speculation and all the sort of press around it, but there is now, we are sort of getting to a stage where these companies are popping up on the radar of private investors, etc. And Paramount is going to get bought out by a company called Skydance. And, so we're expecting massive consolidation, which we think will have to happen because the current status quo is unsustainable. And in that environment, we want to own the cheapest assets because that's probably where you'll get the best returns. But it has been difficult, and it has tested our own patience as well.
It's really good, to see that a company actually sticks to their guns. Like I said, you've delivered them the goods before. And I think the question investors has to ask himself is, do you want to buy more of the expensive stuff, where you actually want to get into companies that are well priced and where you can actually see a big turnaround coming through? That's the answer we're looking for. Question from the audience: Tesla share price trading at $209 PE of 58. Where do you see Tesla share price going in the next 12 to 24 months? As this is one of your top holdings.
Yeah, so we don't comment publicly on sort of our fair values or on where we think the share prices will be. Maybe one way to answer this is to say we get a sort of a low to middle digit total rate of return. So when we look at companies, we forecast earnings, we do a projection 4 years out, and we calculate an expected rate of return. So for a company like Tesla, we have a 4-year rate of return on only the automotive business. So that's only the cars, excluding everything else, okay, of a low single digit. Only its car business will give us, we think, let's say somewhere between a 2 and 8% return, okay? But then on top of that, we add all the other businesses. And those all, in particular, full self-driving and robo-taxis, okay, in the medium term, and in the longer term, Optimus, those all give us tremendous optionality. And all you need is 1 or 2 of those moonshots to work out. And it transforms the TRR from a kind of a low single-digit TRR to a high double-digit TRR. So high teens or 20s or even in the 30s if Tesla is successful. So we think base case moderate, but The company has tremendous optionality, all sorts of little things that can go right, and should they go right, will add to your returns. And in fact, all those opportunities are currently in Tesla's cost base. Tesla's spending a lot of money training the neural network. Tesla's spending money on Optimus. It's not monetizing that. So that's not in Tesla's profit. So anyone looking at Tesla's current PE is misguided. We think that all adds to future optionality, which makes it an incredibly attractive opportunity and very different to anything else we can see in the market. So we like the optionality value that's in Tesla. And that to us is the real thing. And this is why you need to take a sort of a longer term view, because I think the market will only recognize it once it happens. But by then it might be too late.
Simon, most definitely, and your insights to Tesla is very valuable. But I think more so we shouldn't lose sight of what you're actually doing in the fund. You've mentioned a couple of other great holdings as well in the portfolio, in the fund, where there's a lot of the value that can potentially unlock. And I think that's what we need to focus on. Still a couple of questions from the audience. Sean, we'll definitely get you in touch with Simon. I think you can have lengthy conversations on the portfolio and Tesla and more. A lot of curiosity there. Unfortunately, that caught us hands down. Simon, again from our side, thank you so much for coming online. It's always great to have you join these conversations.
Always great to do this, Eugene. Thank you very much. Thank you so much. And thanks to all our clients for sticking with us through both the good and the bad.
And with the next presentation, you're going to talk to us how the fund turned around.
Exactly.
Definitely. Good stuff.
Great.
Simon,
thanks, Eugene.
Chat soon to our audience. Thanks so much for attending today again. To all our presenters, that all the effort you put in managing our clients' portfolios and clients' money. We are deeply grateful for that. To the BCI team, Olga and Tanya, thank you so much for putting these sessions together, making it work. And Dan at the back, Excel Academy, for driving all these sessions seamlessly. A lot of thanks for that. We're looking forward to seeing you the next coming 2 weeks, where we start with our live roadshows. The first one kicking off in Pretoria, the 3rd of September, followed by Johannesburg, George, Durban, PE, or Gqeberha. I hope I got that right. And we're finishing in Cape Town, 12th September. Looking forward to seeing you all at the live sessions, and we can engage with the portfolio and the fund managers. All the best. Chat soon. See you next week.